Okay, thank you for coming. I started the recording. So again, this is my weekly coaching on how our trading system works. And in this coaching, I add something, some new topic to explain to you as we move along. So when the day begins, I have already prepared the watch list one night before. So based on the criteria, I filtered the stocks in the different baskets. So I have 500 stocks in my list, and then I further break it down into the different baskets at what stage they are in, whether they are already whether I'm looking for the pullback. So these are the stocks which need to be pulled back, or these are the stocks which have already pulled back and they are sitting at the support, or these are the stocks which got clobbered recently and then they hit the support. They're sitting there, maybe they might be turning around, or there could be some stocks which are topping out. So they are sitting at the top and there may be slight negative news and the whole all the stock in that category starts to come down. Then it's me during the day where I have to find out which one out of those stocks I need to select for the puts, and also depend on the market. So what is the market condition? So market for me is bullish now, and I'm waiting for one of my signal to come, and that will be the signal for the market for 3-4 weeks to keep going. I got that first signal on 17th of October. Is my first long signal. So I'm waiting for the second to come. The market can move up. So the way the market is moving is market can move up and down and up and down, and then there's no strength in it. So one day when there's no strength, the stocks they just go up and then they come down, then they go up and then they come down. So they do that all day long. Every other day they go up and then next day they're just down. So that tells you that the market strength is choppy, neutral zone according to my algorithm, and not all the stocks are participating. So the stock needs to participate from various uh, indices. So Dow Jones, Nasdaq, Russell, S&P. So they need to participate. So just uh, one type of stocks are moving, not good. So usually the Nasdaq stock, the big movers, the tech stock, they are the one. Sometimes it's the construction stock, sometimes it's the oil stocks. Oil stock can move up, all the rest of the stocks are going to hell, but the oil stock can be going up or they can be going down. So, but you need to be prepared every day to trade oil stocks. So when the oil is active, it's going up or going down. Right now, the oil stocks are just moving up, breaking out. So I don't know when they will be crashing. So they are up. So the tech stocks are showing a sign of moving up, like AMD, especially the chip stocks, AMD, NVIDIA, etc. AMAT. So the Apple broke 150, so that's a good sign. So all the Chinese stock they got clobbered yesterday. So yesterday I was looking at Chinese stock if there's any other room for further, but I realized that they are oversold, so I ignored the, the Chinese stocks. They are not yet set for long. They're very weak. So another thing, when the market is turning up, and so market gives a signal, let's say long signal on one of your criteria, then you're looking for some. You have to remind yourself that I saw this signal on a minor trend. Now I'm looking for a signal on an intermediate trend. So no matter what, I should be looking for the long side. That's my belief, because if something happened, let's say A happened to the upside, and then the B needs to happen, and then the C needs to happen. So it's the first A. If A has happened, what are the chances that A will reverse back, meaning minor trend reverse back to the downside? Maybe. But if you spot that there is a support, and the chances are the intermediate trend, which is, let's say, B, is about to move, it could be going up, then your odds are in your favor to position yourself in the long side. So position yourself on the long side. Look for those stocks which pull back. So or the stocks which are forming the base. So that's where the most of the money is in the initial trend based on again my belief. So I am giving you my belief, and if my belief your belief doesn't match, then we are in disagreement, and we will not be able to trade what I tell you to trade because it doesn't match, and I will not trade your stocks if my no matter what you say. So in my initial years, I met somebody named Chief. So he used to send me stock and say, "Hey, Noshi, I bought 1,000 shares of Home Depot." And I look at the chart and I say, "I don't know what Chief is looking at." And then 2, 3 days later, he says, "Okay, $3,000, LOL." So I look at the chart and I say, "Chief, I didn't see anything." So he said, "Well, wait, I'll show you something else." And then 2, 3 days later, again another. He says 1,000 shares here, and then I look at it and I said, "No, this I don't know what he's looking at." Then 3 days later, he come back and again says, "Okay, $3,000 or $2,000, LOL." So my beliefs were not aligned with his belief. So I was having a problem, and I do have a problem with all the other traders out there when they send the chart, etc. So so I have so much contradiction with other traders that I don't follow anyone. I just don't follow. I develop my own. So if so I have my own criteria, my own rules, and if it doesn't match, I don't trade. So I created the list of the beliefs. So I'm preparing a long um, session on just traders' beliefs. So what we believe and how we believe, and what we do, which is harmful for our trading based on our beliefs. So slight changes here there will make us a better trader. So that's another topic I'm working on, like 30, 40 slides already, and some charts and some diagram. So the things can be explained better when you explaining via diagrams or explaining something in a simple way. So I'm working on that presentation. I'll teach you about the belief the traders have, their various levels of belief. So I learned from the Nobel Peace Prize people, experts, the PhDs, the doctors, the coach. So I go and evaluate, search for these experts, and I learn from them whether those topics relate to trading or not. But then I try to relate to the trading. So that's the way. There's so much out there. We just laser focus on a trading related aspect. That tell me how to run the scanner. So run the scanner is just if trading is A to Z, then running the scanner is a small a. So think about that. If trading is A to Z with all the small letters, in small letters, and all the capital letters, then running the scanner is little a. So the traders, they just want to learn the scanner, little a. So they become like a frog in the well. They only see what they can see. So the frog in the well are those traders who just want to run the scanner and tell me or give me some hot tips and just tell me when to get in and get out. That's it. So I'll show you some slides how my trading system works. So I used to trade alone. So that's where every trader starts, trade alone. But it's not good to trade alone. Need to have a trading buddy, at least two, on side by side with a different background, diversity, not from your country, not the same degree you have. So if I get a trading buddy who have the same degree as mine, who is who my homie, and think the same way, have the same engineering background or IT background, that's the maybe that's the will have a failure there because my training buddy is not thinking differently. So thinking differently is the key. Bring the creativity, imagination in your trading. What is missing? How I can solve the problem? Or who I can approach? Who is the person who can guide me? Or who I can pay? Who I can share my knowledge? All that brings the results. So I've been doing it all my life, from my school age, from a very young age when I was 10, 12. So I'm telling you how you can improve your trading. So when I was little, in the 10th grade, or not in 10th grade, 7th or 8th grade, my math was very good in physics and chemistry, and I always wanted to be number one. But there was a student whose father was a school teacher, and he used to be number one. So his name was Imtiaz, I remember. So there was another student named Arjun who also wanted to be number one, and me. So all three, and Imtiaz just keep always number one. So I approached Arjun and I said, Arjun, you know what? We know Imtiaz gets some slack because his father is a teacher. So how about me and you get together and we practice math together early morning, and we come up with all the solutions and practice, and let's beat Imtiaz. So I used to go to Arjun's little cottage, mud cottage, and practice math over there. But we still did not beat Imtiaz. He was still number one. Sometime I come number two, sometime Arjun come number two, and Arjun is three, I'm number two, etc. So this is the way I applied in the trading also. So I formed in the initial stages, and still right now I have a team. So whenever the new problem comes, I present the problem to my team, and I say, okay, this is the problem I need to solve, so let's get together. So one person can be the idea, and another person can be the solution provider or developer or clarifier. So figure it out in your trading, what problem you're facing and how you can solve, because there is a solution. The idea is there is just a solution, and some people, they don't have the capability to find the solution. They just cannot. They know the problem, they have the idea. So I have a team now, for a long time now. So I developed the system. A lot of things which I was doing manually, now it's automated. So I'll explain to you some of the things I do and the way I communicate, or my team members communicate. So you wouldn't notice if I'm communicating to you or my team member, because they have been trained to say the same thing what I am saying or I'm telling them to say. And so 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 the idea is that you need to have at least two trading buddies in your team with a different background, someone who is different, uh, not the same backgrounds, not the same engineering, not the homie, etc. It's someone different who thinks differently than you think. So here's the example of a meta trade. So let's say I spot the trade meta, and the way I can spot the meta could be different. So it depends what the meta is doing. So it depends on what the trade symbol is doing, and then you figure it out what it will be the next step, and that's where you will intervene. So you're looking for that scenario where you will intervene, and then you will play accordingly. So if the deal is not there, it's not there. But if it's there, then you intervene, and then you start to intervene and start to look at the symbol. So let's say meta is falling, and it's falling, and then you're looking for a support somewhere. You know that this is the support level. So where the support level, support level, because the main support is at the daily chart or some weekly chart, not on the hourly chart, etc. So or you can on the hourly basis you can get the big picture. So 60-minute chart can show you the big picture of the full landscape. It's like sitting on, when I used to travel, or even now, if I'm traveling on a bus, I make sure that I'm standing early in the line. So I get to choose the seat, and my seat will be the front seat next to the driver. So there are two, three advantages. I can talk to the driver, I can communicate, I can learn something from him, I can have a full landscape view. And if the fire breaks, I'm in the first one to exit from the door, not sitting behind and the last one to exit. So I may not be exiting from the bus if the bus is on fire. So 60-minute chart gives you the landscape. You can identify your support and resistance, but pay attention to the daily chart. So let's say I find the daily chart, the meta is it's at this support. So now I'm stalking the meta. I'm not trading it immediately, because the support, if it's a support, it needs to show some sign. This one is really moving up. So let's say I find the support at 125, 128, and it's trading up and down 125, 128, and then finally it starts to show some sign of move. The way the stock move is, you can see like a horse move, trotting those horses which they display, on some parade, etc. They are moving beautifully. They move. So the same way the stocks show you the rhythm. So let's say I spot the meta now I've been stalking for a few days now. I see the meta is moving, so I have it on that watch list. So the watch list is exactly when I see the meta on the watch list, I exactly know where the meta is, what kind of watch list this is. So I immediately get alerted that this is the kind of a watch list I have, and this is the stock, and Meta is there. So it's not easy. So it requires a lot of work. So like 6, 7 watch lists on based on different criteria. So one of the criteria, the watch list, the Meta comes. So I look at the daily chart, then I lean on towards the weekly chart, and I say, okay, weekly is building up. It got clobbered, so weekly is not there yet, but the support is there. So if you look at the weekly chart, you may not see any sign because the stock is clobbered, but the daily chart is showing you some signs. So now you'll start looking to pay attention to your intraday chart. So the signals should come to you on an hourly bit on hourly chart. If the daily chart is your main chart to spot the trend, then your signal to act, to feel good about it, to recognize that the signal looks familiar, should be coming on an hourly chart. So you're stepping down one time frame below your main time frame. So the main time frame is daily. So one step down, you step down and say, okay, 60-minute chart is my chart where I'm seeing the sign in that stock, and then you need another 2 time frame below 60 minutes. So your choice, what time frame you want. So I go 30-minute or 39 minutes, something like that, and then a 5-minute chart just to fine tune. I don't want to get in when the 5-minute is rolling down. So I have to remind myself that pay attention to 5-minute chart when you push the button. So you don't want to push the button to buy when the 5-minute is pulling back. So you may get caught. You may buy a little expensive. So when the meta triggers, so it's an alert meta. So the traders don't want my members or me. I don't want someone to send me the long story. I'm not interested in long story. When somebody start telling me long story, I tell them to stop, 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 stop. Don't tell me long story. Just give me some gist, like brief. Go do this. That's it. Why? Tell me later. I can talk to you later. Just tell me do this, and I do that because I'm very busy. So imagine you guys are busy, so you don't want to read the long story about the fundamentals and why you should be buying this and what your projected earning is this and all that nonsense. You're just there for 3, 4, 5 weeks. All that nonsense about the fundamentals and all what the Mark Zuckerberg will do is all nonsense, noise. What you're looking for is clear-cut signal to go long. So I provide this simple line, meta, the first symbol, then the month, and then the strike, and then the type of the trade, whether it's calls or put, and then buying to open at $10. So that's what it goes first time. That's it. And in the subject of email, and if you have signed up for SMS, then SMS is you also receive SMS disk. So you open your app and you execute the trade. Most likely you will be able to trade at 10 or 990 or 980, maybe 1020, etc. So later in the email, you will start seeing this stock meta, month is December, strike 130, type call, action buying to open, suggested price 10, and third Friday expiry. So we always buy third Friday. That's where the liquidity is, not the quarterly option or a weekly option. Weekly option, unless you are very right, is playing fire. Uh, I know the stock will hit this target. I know Meta will hit 137, but I may be wrong in timing. And if I'm wrong in timing, then I was right in the direction, but I was wrong in timing, and then I lost 100%. So I don't want to trade uh, weekly. So I just don't. Maybe there's money, but I don't. So third Friday expiry option. Now, after the uh, after the the screen don't move because I stay in one screen for a long time. So I'm not changing the screen quickly. I'm just staying in one screen and talking a lot. So this is another problem. People like to see the screen. Okay, you're talking on the same screen for a long time. What happened? Are you not showing? I'm not showing. I'm just showing one screen. So talking. So I don't know. I'm not changing the screen. I'm talking and showing you one screen. So trade target. Now when you put the trade, you need to know immediately before putting on the trade where the support is, where the resistance. So support and resistance tells you where are the turning points you have in previously. So all the turning points, all the support and resistance needs to be analyzed. That's where you put the targets. So it's better to have 2 or 3 targets. The more targets you have, the better it is. So you can plan your trade. If just one target, then the target should be reasonable, not a quick target, 10, 20 cents, 50 cents, and then I'm out. Not good. So you have to be, if you take a small profit, you have to be right 100% of the time because you will lose bigger. So you can make bigger gains and you can be right maybe 60, 50, 60, 70% of the time, and you can be ahead in this game if you're right 60, 70%. If you take a small profit, you have to be right almost like 100%, and you cannot be 100% right. So unless you're trading 10,000 shares and looking for 2 cents, 5 cents, and then every time you enter, you get 5 cents. So maybe the big boys do that. They never have a losing day. 2 years running, never have a losing day. They have all the tools and resources and whatnot. They just front run and look for the penny. You know, they just go. They see your order and they buy it before you, and then they sell it to you and make a penny. So they do that all day long. But we are not like that. So we analyze the big targets. So big targets, at least some targets there. Sometimes the stock give you the chart pattern is developing, but you have to make sure that you're not going long on a overbought zone. So some stocks they pull back and they pull back at the top and then they are sitting there and then they give you the signal. It looks like, oh, it's gonna go up, but then when you take one step back and you look at the big picture, and then you say, okay, it did pull back, now it's going up, but it is going up from the top part of the chart. So what is the likelihood that it will continue? Maybe it will break out. Maybe it will break out and go and make a new 52-week high, or just keep going. So I try to avoid these kind of stocks which pull back at the top and then reversing to the upside. I need some kind of a decent pullback, and then they are moving up. So what criteria? There are many criteria, whether they are, they gapped up or they gap down and then they gapped up, or they are reversing sharply from the support, or they were trading narrowly for last 3 4 days and now they are breaking up, sudden move up. So something has changed in their trading. Or intraday they were going down, like yesterday there were some stocks they were going down yesterday. So I started looking at those stocks which were going down. So I was wearing the hat of the from the other side. So I was saying to myself, okay, these are the stocks which are going down. Now, which one will go, which stop going down and will go up? Which one is just going down temporarily? So I identified Nvidia. So Nvidia was going down yesterday, intraday chart, if you look at it, and then suddenly it started to reverse. And the reversal, so when the stock is going down and it's reversing, the reversal is not like a lame fashion. It's like, think about, if I'm walking from north to south, I'm walking fast, north to south, as if I'm just going and going and going. If somebody's watching me from north to south, he will definitely say, this guy is going towards south. But then he turn around and then he see me turning back. And then I stand there, look east, west, take some steps towards the north, then turn back towards south, and then maybe I turn to east west. So if the guy is watching, he will say, okay, this guy is confused. He doesn't know now which way he's going. Most likely he will go to further south. Right now he's just taking a break. But if he see me, okay, this guy was going from north to south. Now he's coming back. What happened to him? Okay, let's see. Then he see me turning around fast, and I'm moving towards north. So if I'm moving towards north, then what's the indication? Maybe okay, I cross the criteria is I cross one block. Okay, so he crossed one block. So what's up with him? And now he's crossing the second block. So when this is happening, it means this guy was going in a wrong direction. He was not supposed to go from north to south. He wants to go to north. So same way the stock when they are going down and then suddenly you start moving up, then you are looking for those stocks which are sharply moving to the back to the original direction. So for me, example, if I go back to the original position where I started, I may hesitate at that time. I will further evaluate. Okay, I think I was lost. Now I'm back to where I started. Let me see which exit I need to take or which way I need to go, or should I just stay there here? So same way the stock, when the stock reaches this starting point where it dropped, it will hesitate because there are buyers and sellers there. So it will hesitate and then they will come to an agreement and then the stock just moves up. So yesterday was Nvidia. So Nvidia was trading around 24, 224, something like that, and then started to move up. So I said, okay, I think it should stop going down now. What are the chances? So at 225 or something, I entered long, knowing, thinking that the Nvidia was going down for no reason. Now it's going up. So position yourself towards long. And today you see Nvidia is going up. So that's the example of one of the examples of stopping the trade and fitting your criteria. So now I need to, once I enter in Nvidia, then I need to know where I will exit. So I have my target set. And when this kind of a reversal happens, then find out what other turning points are there. Like yesterday's point is one, then before 2 3 days before, where was the turning point from where Nvidia has turned around, and it should not violate. If it violate, then um, your trade is not working. So the targets, so the targets are set, and the stocks sometimes takes time to hit the target. Sometimes they just go fast. So we all know that. So the further the targets, the less time it, more deviations it has, because there are obstacles in between. There are news, there are traders, there are market, whatnot. So the trade may deviate, but then it will go and hit the target. So there are obstacles in the way. So work backward. Maybe you find the target and then you work backward, that this is the way the stock will travel. So create some kind of a map, and then figure it out. So we have three kinds of target. We call it green target, yellow target, red target. Green is the first target, and the yellow is the second, and the red is the third target. So it's similar. So 10 years ago, when I was thinking, okay, uh, so I need to communicate the target. So I said, okay, it's like just like a signal. And then they have a poem in the school also, green light, what do you say? And the yellow and the red, to teach the children and to adults. And there are adults who don't stop at the red, they just keep going or don't slow down at yellow. So the green, yellow, and red. So similarly, green, yellow, and red, just like traffic signals, first, second, and third. So the green target is it's like a smooth sailing. So the stock will hit this target. So the closer the target is, 3%, 4% from your entry point, the chances are high it will hit, because you saw something in the chart and there's a momentum. So the momentum will take you to that target, which is closer, like green target. So that's why it's called green. Is okay. So what is green? So green is the immediate target, the first target. It has a very high probability. So assigning the probability is easy. If you are stepping on the stone, I mean, you can step on from the stone if the distance between the stone is not much. Then if somebody asks, okay, can you jump these stones? And if you miss, there is a 100 feet cliff. So if there is a big reward, then you say no, the stones are closer, I can jump. So you assign the probability, yeah, 5% I may hit, but then if, so then you have to evaluate. Okay, if this 5%, there is not a probability that there is a probability 5% that I will not be able to jump. Then what will happen to me? If the answer comes that you will die, then it doesn't matter if it's a 99.99% probability. If it's 0.01 probability you will die, you will not take the trade because you will die if it doesn't hit. Just like you are taking a plane. If they announce, okay, there is a 99 percent probability we will reach Timbuktu. So would you take that plane if the pilot announces there is a 99% probability we will reach Timbuktu? You will not take that plane, right? So in trading, you are figuring out the target which has a very high probability. You cannot be 100% sure, otherwise you become God or next to God. So you don't want to create gods. Uh, so 95% probability of stock hitting the target. So your analysis is saying that this target is good enough for me and I will make decent profit. So 3 to 4% move in the stock will give you 40%, 50% gains. So the system, so my system, as soon as the trade is sent, the targets are set for me to get alert and to take some action. So when the target hit, I also get the alert. What is my option trading? I bought at 10, it's trading at 12. So 10, it's trading at 12, the green target hitting. So 20% gain. So 20% gain is not that bad, but it's $200 per contract. So I need to figure it out if I sell on the green target or I hold further. So if the market is bullish, trending, I will start ignoring the green target. I will go for yellow and red target. If the market is choppy and one day it goes up and one day it goes down, then I would be looking to exit from the green target. So in other words, I'm not only trading in isolation, I'm also looking at the market condition, what the market is saying and what positions I can open, other positions better than this one. So maybe the green target hits after 10 days. It took 10 days to hit the green target, and even though it hit the green target, my position is at break even. So if that's the case, I will just exit from unless it's just picking up some momentum right there when I'm trying to exit. Sometimes we make mistake, we exit right when it starts to build up some momentum. But in general, we sell 1/4 of the position or 1/3. So you get the alert to sell half or 1/3 or 1/4. Uh, Ideally, you should not be selling, taking profit too early by selling at green target. Only if you have a large number of contracts and in options, if you miss the sell, then sometimes it just goes back and you see it trading at the original price. So ideally, the way you manage is trade is you sell on the yellow target. So that's the optimum target, because after hitting the green target, unless we tell you to sell, you should be holding it for yellow. So whenever the target hits, I get the alert. And when I get the alert, whenever your target is hitting, you get the alert. Then you need to be disciplined enough to evaluate that trade right at that moment. Go through the evaluation process and see what is you are missing, what you missed before, and what is new, what new things have developed. Because you entered the position 7 days ago, now the green target is hitting. In 7 days is eternity. A lot of things can happen in between. Maybe it has developed some resistance, so you're ignoring it. So if you put on the trade and say, okay, I bought 10 contract, I'll sell at green and I'll sell some at yellow and sell some at red, and it's just sitting there and you're cruising and drinking champagne, a lot of things are happening in between. Maybe there is no potential left for yellow and red. Maybe there is a big resistance developed at green target. So so my system tells me how many times the green target has hit, and on what date it hit, what time it hit, and what was the option price. So all that goes on, and how many days have gone by that the green target hit and the yellow is not hitting. So if that's the reason, that's the case, then you need to sell at green or sell before hitting the yellow. because it's taking time. So whenever the trade starts to take time, you give some leeway, like 3 days. You say, okay, I give it a 3 days after green target hit. I give 3 days, and I need to just exit. So go and look at the chart, see if there is a congestion, see if some resistance developing, see what other stocks are doing, see what the market is doing. Is there any news coming? Is there earning news, FOMC, etc.? So what is the this is all the management of the trading, which the traders don't do. They just want to give me some hot tip and just let me know when to exit. So, but most of the time, so the way the green target is given to you is knowing that there is a room for further growth in that position. So sell some alert is sent. Then after the green target is hit, then the yellow target is sent. So yellow target is set in case of calls. The yellow target is sent just below the resistance level. Some leeway, some percentage of ATR based on the volatility. The volatility could be 10-day, 14-day, daily, or some resistance you have calculated, and you say, okay, this is the resistance I calculate, and based on the resistance, then this is the leeway. So the formula you're applying is almost the same. So if you develop your system based on some mathematical formulas, so mathematics cannot go wrong. You put 2 plus 2 and you always get 4. Sometimes you get 5, but you know why you're getting 5. And sometimes you add 1 plus 1 is more than 3, much more 3. So you say, okay, this one is giving me not 3, is more than 3, and I need to adjust my yellow target, or I need to hold the trade on yellow target because the resistance is being broken very fiercely, like with a big volume. There's a news, there's a gap up. I need to hold, so I will not sell at yellow target. So if you're managing your trade yourself, then you should be able to, and you're skilled, then you should be, your result should be better than the person who is providing you the guidance, because you're taking his expertise and then you're applying yours, and you're coming out ahead of that person. So if you're behind, then you need to catch up. If you're ahead, then you are, so you are ahead because you're taking his, and then you're applying your own, and then you're making 2 plus 2 equal 5. So the way the second target in my system is set, there is a very high probability, 85%, but there is still a 15% probability. So people tend to pay attention to this high probability, but they didn't ignore the what is the chance of. So there is a 15% chance. So what if that trade doesn't hit 15? Then what will happen? Like we are there are deals, they give you deals. Okay, this is buy this for this price, and you will make this much, and then there is a certain probability you will make not anything. So 15, but there is a 15% probability of the stock not hitting the yellow target. So when the trade is going on, evaluate, see what is happening, that the stock is not hitting the yellow target. What is going on? So when the stock is hitting the yellow target, we send you the trade alert, sell alert, that sell majority of your trade or sell half of the trade. If we see the yellow target resistance is broken during the market hours when we evaluate, and I send you the revised target. So I'm doing it, and this happened during the market which is trending to the upside. It looks like that market is coming right now. We will know in 1 or 2 days that the market trending up is setting up, which continue, like the market which goes up. Um, let's say there are 5 trading days, and out of 5 trading days, the net result for the week is up, and then the next week is up. So that kind of market looks like it's developing. So stock expected to pull back after hitting yellow, sell 3/4 of the original position. So you hold only 1/4, which you are looking to sell at a higher target or at break even. So you don't want to sell below your cost price. So manage the trade like that. So if you have 8 contracts, sell 6 or 4, half or 4. We do send out the alert, sell half or sell majority, etc. And if the stock hesitates to move up, sell rest. So 3 days gone by and the stock is not moving up, then sell the rest. So when you're selling the rest, you may not get the same price that you sold at the yellow target, because 3 days of time decay. So 3 days of time decay, maybe a little bit of pullback. So don't feel remorse. I mean, have a remorse that, oh my God, I should have been better off selling all at yellow target. So if that's the thing happening to you, then sell all at yellow target. So after yellow target is the red target. This is the ultimate target. So this is where I set it up, where either the overbought, so for calls, where or for going long, where it will hit oversold position, overbought position, where it's overbought. So it will get overbought. So the stock may have been moving. From the entry point and to the red target, how many days it took to reach the red target? It's not sometimes it just next day it hit the red target. So one shot and it hits the red target, and that's overbought. Or it may took 10 days to reach the red target. So 10 days, it took 10 days for the stock to reach the red target. And out of 10 days, there were 6 up days and 4 down days. So it took a while. So, and then on top of that, there's a resistance. So it took 10 days to reach the red target. Um, and the number of days so I track the number of days. So number of days, if you track number of days I'm in the trade, whether it's a calendar day or trading day. So if it's calendar day, maybe 10 days. If it's a trading day, maybe 7-8 days. So you figure it out what you're tracking, calendar days, trading days. And then you also look at it, okay, how many days left in expiry? Options are, after all, options expire. So it's like ice cube. So you're evaluating the days to expiry. So when you put all those two plus two together, how many days you have been, how many days it took for the trade to hit the target, how many days left in the expiry, how many contracts you have left, how many open position you have, and the market condition, etc. So when you put all this, then you decide whether to sell it immediately a red or hold. So we send you the alert to sell. If we have sent you the alert to sell before, majority or half or some, then we send you the alert to sell rest. Otherwise, we send you the alert to sell all. If we have not sold, then we send you the alert to sell all. Otherwise, we send you the alert to sell rest and close the trade. So the trade is closed. And then we send you another reminder in case you're holding. Sometimes the traders miss the trade. So we spot. So I keep the open trade, which we have closed, let's say today, I'll keep it for another day or so to watch. So just in case what it's doing, it's like, okay, I abandon this trade. Now I see what it's doing. Maybe it's coming down. Maybe I get the opportunity to buy puts, or maybe I need to send a reminder to the members that they need to get out. So all that goes on. Sometimes the red target is revised. So there's a reason for red target, like I'm keep on revising the CRM target, and so CRM keeps moving up, XOM keeps moving up, um, TMUS keeps going up. So there are some stock which just keeps going up and up. So why why sell? I don't send you the alert to close for the sake of closing the trade and beating my chest that here is the winner. I try to hold it. So every day I'm looking at making sure for all the symbols I have in open, I'm making sure that okay, they are all right or they are going up. If I get the alert for the trade to hit, if it's hitting the target, then I look at it immediately and I say, okay, is there a further potential? Is there some resistance there? Is there something I'm overlooking? If not, where is the next one? Okay, this is the next one. So I revise the target and send to you so that you can capitalize. So the red target for TMUS, OX, not XOM, SLB, uh, CRM, these are getting revised. The other ones building up is NVIDIA, AMD, etc. So, so the red target is revised to capture more gains. So now there are certain, if you are already in a position and it triggers something which tells you that if I was not in the position, I would have entered in this position. If that happens, then what would you do? So let's say you're holding a position and it gaps up. So if it gaps up, then you need to evaluate that gap. whether that gap is a sell alert or buy more alert, like adding more. So adding more to the position which you already have. So you are averaging up. Maybe you have a position and is you're losing and is you are averaging down. So all those things you need to evaluate for the stocks which are gapping up. So in the morning you need to see, okay, this is stock gapped up. So it's easy to see gap up. You can see clearly on an intraday basis chart. So you can see on a 30-minute chart and say, okay, and it looks like it gapped up right here. And then when you look at the day chart, you can clearly see the gap is there. So the intraday chart tells you clearly how much gap. And then you look at evaluate that gap area and see if there is a resistance or what. If the gap, if the stock, so there are techniques for trading gap. So if the stock gaps up to an area, then you evaluate whether to hold or to sell. So I send you the alert. My team send you the alert based on my instruction to hold or sell. So so I'm looking for certain criteria for the red target, and if it meets, then I revise the target. Otherwise, I send the alert to sell uh, at the gap. So sometimes it's a great opportunity to sell at the open. Like I cannot even wait for it to sell because option market doesn't open fast, and the market maker, he has to set his books for 10-15 minutes. So you would see the spread is wide, and you're trying to buy something and then you cannot buy because of the spread is huge, or you know, it's just crazy. So you are at the mercy of the market maker, of the option guy. He has to take care of his books. He has to go home. He has to report to his wife. He has to report to his boss. He has to make some money. So he cannot go in in red. So that's why we see the stock gaps up, and then you cannot sell the option. You have to wait. So you have to put that stock into your detailed monitoring mode so you can take some actions and forget about opening a new position. You're looking for that stock which is gapping up so you can take care of it. So sometimes we sell it immediately. So it's send you the alert to sell. So revision of targets, we do revise the targets to the upside. When the target is revised to the upside, then the second target is replaced by the third target, uh, and the first target is replaced by the second target. So they just displace one step on the target for the calls and for the puts. And sometimes the targets are adjusted to the downside, and it's based on the congestions the stock creates. So if the stock is hitting and yellow and it's just sitting there, or maybe below the yellow. So if the yellow target was 100 and is just sitting there at 99 and it's just not moving, and it hit 99 today, and then tomorrow it hit 98, 90, or 99.10, and then it's doing it for 2-3 days. So that 100 target is revised to 99, and then we send the alert to sell and close it. Uh, it's too much resistance, or it's not looking good. So the traders need to develop multiple exits. You need to have multiple exits instead of one exit. You can have one entry, but having a multiple exit pay um, pay dividend. So it's like you need to, for every problem, you need to have a multiple solution, multiple choices. So you're not at the mercy of one choice. You have multiple choices presented to you. So the same way for trading, you need to have multiple exits and multiple times you can buy, add, and sell. Don't buy just one shot. I bought this. Now what? But if it goes straight to your target, you will make a lot of money. But if it doesn't, then you're holding it. So we send all this kind of sell alert: one third, half, majority, rest, selling all. Sometimes I give you sell price range in stocks or option range. So depending on the stock, if it's moving up uh, or down, so we don't know where it will stop. But I figure it out that okay, if it keeps going down, by the time the day is closed, it should be uh, trading at this target. So I'll give you the range, then calculate the option price, estimated option price, or the stock range for the target, and sometimes the alert is to sell by the close. The market is moving, the stock is moving, so you can close. If you're in a big profit, then this kind of alert works, sell to close by market. Then you can afford to hold it till the market close, because the stock keeps going up, but you have to close by the market time. Let's say 10 minutes before the market closes up, it's Friday, then you have a big profit, then it's okay to hold. Or you can set some trailing stop. I don't set the trailing stop on options because it always works against me. I get stopped out on option. So sell to close by market is another uh, sell alert. So another thing, well, the last thing which you need to know is all your position. You need to wake up a little early and see what they are doing in the pre-market. Sometimes the stocks are moving in the pre-market and you have a position in it. So see what the highs and lows are made in the pre-market, and see if one of those highs and lows are your target. If that target is hitting in the pre-market or aftermarket, then it may be the ultimate. And then when the market opens, they may not move above your targets. So then you're holding it and wondering why it's not going up, because the target has been hit in the pre-market hours. So somebody, let's say your target was 100 for the stock to sell, and it came with the good news. It was trading at 95. Now in the pre-market hours, it traded at 100, and somebody just sold it a lot of shares at red target. So, or there are no buyers at 100. So when the market open, it will open like 99, 50, 40, and then it's not going to 100. And then you wonder what happened, and then by the time the market closes, you see it standing at 98. So you then, if you go back and dissect, then you say, oh, it hit 100, but it hit in a pre-market hours. So in that situation, you sell your options at the open. So chances are stock will pull back. That's my understanding and reading. The stock must gap up above red target. So if the pre-market it was trading at 100 and your red target was 100, so when the market opens, it should open at above 100 and stay above 100, or it shouldn't go down below the low of the day during the first 30 minutes. So you can apply the opening range breakout strategy and see what was the low during the first 30 minutes and what was the high during the first 30 minutes of all the up and down move, and what it's doing. So you can watch on a 5-minute chart. If that is one of your candidate, you need to watch it on a lower level time frame to make the decision. So when this kind of situation occurs, we send you the alert during pre-market hours. Let's say we send you the revised target, we send you the strategy to close or not to close, or we send you the strategy to buy more, so etc. So you can add. So adding at there are various strategies to add. I explained in a different session. So you can add by buying new strike same month, or buying new strike on next month, or you can when the target hit, you can create a spread by selling your short the calls. So you created the spread instead of closing the position. So you can do different things to maximize your gains once the targets are hitting. So when the target hit, you can create the spread out of the money, or hold or sell that strike and go out of the another strike, buy something more, another. So that strike which was you were thinking of buying, let's say you bought the 28 strike when the stock was trading at 25, so 28 was out of the money. Now the stock is trading at 32, 33. So you can add more if you think it's doing good after pullback. You can add 31 strike or 32 strike. You don't have to add same strike 25. The 25 is way deep in the money now, and you may be selling it, and so you can sell that strike, and then you can buy more number of contracts because you're buying another strike up, or you can sell and then you also have to evaluate how many days left in your original trade. So if the days are left, then you may have to choose the next one, a new strike and a new one. So all this goes on in maximizing the gains. When any news update or anything comes, we do tell you via alert, and I teach you like this. during Monday or Tuesday or any midday, and then sometime on the weekend, like Sunday evening, 5 o'clock. So that's what we have been doing. And yeah, oh, I said FB. So sometimes we do send you the alert to buy more, so buying more of the same. So Meta, December 130 calls, when the stock pulls back, there are many reasons of buying more. Maybe we sold half when the yellow target hit or a green target hit, and then the stock pulls back. So when the stock pulls back, and it's giving us the new buy signal, then we can, and we know we have sold half, so we can buy uh, more. So let's say we bought at 10, we sold at 12, and now it's trading at 6, so we have half of the position. So we can buy more contract at 6 because it's a brand new trade. It's just giving, it pulled back, and now it's giving us the new signal. So we can add more to the position which we sold. We sold half, we bought it back, or we didn't sell, we need to average down, so we average down, or we averaging it up. So sometimes the stock is looking so good that you can average up. So you bought at 10, you bought more at 11. So there are different things you can do. Buy just little. When you're averaging up, you're buying little units than previous one, not more. If you buy more, then you're averaging, the price is going higher. So if you bought, let's say you bought 1,000 shares, and when you're averaging up, you're buying 500 shares. Second, third time you're buying 250 shares. The fourth time you're buying 125 shares. So because you're buying at a higher price, so you need to buy less too, so that you don't offset your average price too much on the way up. So that's it for today, and I will see you. The stocks are technical, mental and technicals. And yes, I will teach you about volume and things on a 1 year coaching. And what else? So I have a 1 year coaching program which is starting in God willing in November, and then I have a 8 day duplicating success coaching, which is not much. I'm just I want you to attend. So if you have any interest in attending the duplicating success, send email to coaching@tradegenie.com. And 1 year program. So 1 year program takes you into detail for 1 year. I teach you for 1 year, and I will explain how I teach and everything. So you get coach for 1 year. All right. So thank you, and I will see you next time.